We want to take a look at gold here, and for that I'd like to welcome in Paul Nolte, Senior VP and Portfolio Manager of Kingsview Asset Management. Paul, thank you very much for being on the show.
Good morning.
Good morning. Let's go ahead and start with gold here. We've been oscillating in between a range, about a $30 range here for most of the year. We saw another failed attempt to get above 1360. What do you think's holding us back from breaking above 1360?
You know, the interesting thing is your comments and the discussion you had in the prior segment about the dollar is exactly what we're seeing in the gold market. For the last 2-3 years or so, gold has been playing off of the dollar. So keep an eye on the dollar to determine where gold is going to go. Gold normally is one of three things. It's either a disaster protection currency, if you will, metal, it's inflation protection, or it's a move against the dollar. But it's only one of those three things, and you only know it in hindsight. And what we've been seeing really over the last year to 2 years is that gold has been moving in lockstep in opposition to the dollar. So as the dollar comes down, gold has been rising. The dollar's been in a little bit of a trading range here, so is gold. So if the dollar continues to weaken, we should be able to see gold get above that resistance level.
So I think that's the main question on everybody's minds out there. Where do we see this range go? Do we continue to see the dollar consolidate, which then leaves gold in a somewhat consolidation phase as well? Or do we see a breakout catalyst here at any point on the horizon? Paul, what's your take?
You know, what we're looking at, our call for the longer term perspective through the rest of this year is generally a weaker dollar. So we should see eventually gold move above that resistance level. The big question, if you will, or the concern that we have in the marketplace is the lack of inflation. We're not seeing the inflation numbers high enough to generate significantly higher interest rates. So the risk to that call is that we continue to be range bound as opposed to see further weakness in the dollar and strength in gold.
All right, let's stay in the metals sector here, but let's take a look at silver, which is moving a little bit less in lockstep with the dollar. What's your take on the silver market here, which has also been in a consolidation phase here for most of the year?
Yeah, the silver has really been the weak sister between gold and silver. We're not as favorable on silver. We would be much more interested in playing the gold market. Silver's had a rough go. If you want to take a look at silver as maybe an indication of strength in the industrial side, it is much more of an industrial metal certainly than gold is. You know, that may give you an indication that some of the weaker data that we've been seeing of late in the global economy is showing up in the silver market, and part of the reason why silver has lagged here, the gold market. So again, more favorable toward gold and silver, a little bit more favorable to international currencies than the U.S. dollar.
All right, let's take a look at the treasuries here. We were just talking about them just a little bit with J.J. Kinnan in our previous show, but I want to dive into them here, Paul. The 10-year was oh so close from breaking 3%, and a lot of people thought that was a given. That turned out not to be the case. We saw some strength here in the bond market. Is that kind of flight to quality coming back into the bond market here as traders saw kind of a pause at that 2.9% and a reluctance to get above that range?
You know, what's interesting is the treasuries have moved similarly to the market, the equity markets. So when the equity market sold off in February, yields rose, the bonds sold off. That has flipped around in March, and it's been much more of a risk-off trade in the equity market, and you're seeing it pick up in the bond markets as investors fly to treasuries away from equities. We've seen a flattening now of the yield curve. So again, a lot of the inflation numbers that we've been looking for, the PCE that came out last week, relatively benign. So we're not seeing inflation, which would show up in the long end of the treasury market in the 10s and 30s. That's not there. So it's going to be a tough road to get above those resistance areas without inflation. The Fed is determined to raise short-term interest rates. Part of the reason why we're seeing that flattening of the yield curve. The curve now at the flattest level that we've seen all year and even in the back part of last year. We're also seeing the tip market indicate lower inflation numbers. So it's going to be very, very difficult, I think, for the 10-year to get much above 3, if at all. We think that market is probably destined to see 2 3/4, maybe even 2.5 sometime later this year.
Very interesting, and you're absolutely right. We've seen a flattening of the yield curve, that 2-year, as well as most of that short end rising here in yields, and we've seen the 30-year as well as the 10-year kind of back off a little bit. I want to get your take, though. What did you call last week's GDP number, which came in at 2.9%, yet consumer spending at 4%, which was well above the target? Would you say that provided a little bit of inflationary data, but you certainly didn't see it show up in the bond market, which might have been surprising to some?
You know, it's kind of, like I said, what we're seeing in the whole of the economic data, both domestically and international, is that we're seeing less inflation. We saw a lot of it come in December, January. You look at the commodity indexes, all of them have popped. Those have all come off here recently. Consumer spending has been decent. We'd like to see that continue if the tax cuts make their way through to the consumers and they do wind up spending it as opposed to saving it. We could see a little bit of a pop there. But right now, again, the advanced numbers for first quarter GDP are less than 2 or right around 2. So again, we're looking at 2.5 as a reasonable number for GDP. Again, very hard pressed to get much above 3 with demographics and productivity levels here. So again, range bound to maybe slightly lower for the Treasury market through the rest of this year.
All right, and I want to focus really quickly here on just the longer end of the curve on that 30-year, which has moved basically last week from 144 into the 146 handle. We saw a very strong move there as well, and I know you said you're looking for the continuation here of the overall yield curve to potentially flatten, the 10-year to move down into those mid 2% levels. How are you looking at the longer end of that yield curve with the 30-year U.S. Treasury bond future?
You know, the longer end is going to be dictated a little bit more by tens. So again, how the 10-year moves, the 30-year is going to be moving. 30-year is going to be very sensitive to inflation numbers. And unless we see inflation numbers pick up, we can see the yields come down there on the 30-year as well. So overall, the dynamic of the market is a little bit flattening of the yield curve all the way out to 30-year, which again puts risks on the economy. As we all know, an inverted yield curve is looking at a recessionary level. We're back to being worried about a recession. Maybe not this year, but early next year, as long as those inversions continue to work their way into the marketplace.
Let me just ask you one follow-up question, because I thought one of Jay Powell's notes here in one of his recent statements was very interesting, that an inverted yield curve at these rate levels might not signal the same things that an inverted yield curve in previous rate situations, where obviously the Fed was trying to get ahead of spikes in inflation. It might not mean the same thing here. How do you think about an inverted yield curve at historically low interest rate levels?
You know, it's an interesting comment. I think we're still going to stick with the historical precedents. We've seen inverted yield curves generally lead to recessions. So until we're proven otherwise, the other headwind that we have certainly is the Fed unwinding their balance sheet, which you would expect to see higher interest rates. We're not. So that type of extra supply is getting absorbed in the marketplace. There is a demand for those types of securities. So our view is that if we do see that inversion, even at these low levels, recession risks are going to be much higher here than normal.
All right, there you have it, folks. Paul Nolte from Kingsview Asset Management. Appreciate having you on, Paul. Thank you very much.